Welcome to Financial Essentials for Business, Growth and Funding. We appreciate you joining us. And again, sorry for the mix-up this morning. With us today also, we have Christy Athens in Wallowa, Lori Skafsma, who is also in Wallowa County, and Jeff Nelson from Baker County. All of them are advisors with the Blue Mountain Small Business Development Center, and all of them are here to answer any questions you might have, whether it's about today's session or anything in general that you may need for your business. All of our advising is at no cost, and we'd be happy to help you out. I know, I think Susan and Nick will have a slide up at some point with all of our contact info, so feel free to reach out to us anytime, jot our email addresses or phone number down, and give us a ring or send us a note. This wouldn't be possible today without Susan Bauer and Nick Nash with Eastern Oregon Business Source, so we appreciate all of their help. And without further ado, since we're already 15 minutes late, let's get started. I'll turn it over to Susan.
Okay, thank you, Eric. I'll just share my screen here. And
it looks like you need to make Susan a host real quick. Now it should work, Susan.
Okay. You might check the recording. I may have accidentally hit a button. Okay. Okay, at this point, I hope everyone can see my screen. With
Susan,
funding. No?
You need to switch the display. So go up to display setting. So you selected, it's displaying your, yep, go there. Yep, click on that. And then swap, yep. Perfect.
Okay, all right. Boy, it is just a morning of steps, isn't it? Well, we're there. Good morning, everyone. Thank you, Eric, for the great introduction. I'm Susan Bauer from Eastern Oregon Business Source, and we've partnered with the BMCC Small Business Development Center to put this together for you. So welcome, very good morning. This is the fourth of four financial series, and today we're going to be talking about business growth and funding that growth. A little bit about where we've been. Many of you have been with us along this journey. Some are just joining us for this session. Either way, do know, and I'll remind you several times throughout the morning, that all of these sessions and the previous series, which was on marketing and social media, are all available on YouTube. And so you can go out to the BMCC SBDC Facebook page and find any of the past sessions as well. So where have we been? We've talked about financial essentials. We looked at some key financial reports, what was included in those reports. Then we looked at how to create those reports and what those reports suggest about our business. We spent a session on QuickBooks and talked about the importance of keeping track of expenses and categorizing income and looking at those things on a regular basis. And then we roll into today, Wednesday, March 24th, and we're going to wrap this up by talking about how do we know if our business is looking at growth or able to grow, and if so, if we choose to grow, how do we fund it? So there's a lot that goes into that, and we're going to break that down with you today. As Eric introduced, the Small Business Development Center is available across all of Eastern Oregon, and the advisors are ready and able to help you with any questions from today or any questions in general. Eastern Oregon Business Source refers folks to the advisors as well, and we highly, highly recommend them for business planning and anything business. At the end, you'll see another screen with their contact information. So if you didn't get a chance to write down email address under each picture or phone number, you'll see this one more time. we highly recommend that you reach out and work with them. Eastern Oregon Business Source is located in Pendleton, Oregon, and we are a strategic development firm offering customized training, grant writing, workforce initiatives, and we also do one-on-one leadership development, and we do so across all of Eastern Oregon and across the Pacific Northwest. We are very proud to say that most of our time is invested in Eastern Oregon, and that's exactly the way we like it. We all live here. We are all very much interested in the future and growth of our communities. Just a quick review these days in the remote environment. We've probably all got these down, but nice to start these sessions out with some quick reminders. It is good etiquette to mute yourself. So if you're not talking, please mute yourself. And if you happen to be dialing in on a phone, please mute yourself there using specifically your phone's mute button. That will help block out any noise going on in the background. This session is intended to be interactive, as all of our engagements are. So please speak up, jump in, take yourself in and off mute as you want to speak. And also know that there is the chat box, which we encourage you to use at any time. We have Eric and the others in the background watching that, so we make sure that I don't miss anything and we engage you in the conversation. Don't feel like you are interrupting. The nature of this remote environment is that we sometimes may have to interject and interrupt, and that's okay. We don't have the benefit of seeing each other's body language and all of the facial expressions where we do when we're in person. So we just have to jump in and speak out. You can also click on the reactions buttons that you'll find at the bottom of your screen, and by doing so, you can react in all sorts of ways, including raising your hand if you would like us to call on you and hear from you that way. Again, this session is designed to be very interactive, so we look forward to hearing your voice and seeing your thoughts a lot throughout today. So let's use the chat box. Let's start out by on a scale of 1 to 10, could you type in and let us know how you would rank your confidence in knowing if your business is doing well enough to support expansion? With 10 being, I am very confident, I know what to look for, I know what that means, I'm ready to go. And 1 being, you know, I'm not quite sure. If I'm making money, then I must be doing well and I'm okay with that. What else is there to know? So on a scale of 1 to 10, how would you rank your confidence?
Not sure if you can see this, the chat box, Susan, but just to give you some of the numbers that are coming in, we see a 1, an 8, a few 3s, some 4s, another 8, a 5, a 7, a 6. So that should give you a good idea where people are.
Okay, very good. Thank you, Nick. I appreciate that. And it's great to have a range of comfort zones on a training session like this, because we always believe that we learn as much from each other as we do any presenter or facilitator. So we look forward to people jumping in and adding to this conversation. The goal for this particular session is to give you the tools, things to think about to help you move up that scale. So if you already are an 8 or 9, I hope that you leave with something today that maybe you haven't thought about before, or something that you would like to give more thought to. And if you're at the other end of the scale, a 1 or a 2, if you move up 1 point on the scale because you've been introduced to something that you hadn't been before, then I will consider this successful. So again, it's designed to help you move up that scale. So what will we do today? We will quickly review the 7 steps to maximize the value of your business. That is from Profit Mastery, which was an outstanding session offered by the SBDC that we encourage everyone to watch for in the event that that's offered again in the future. We'll revisit some accountants' tips for small business owners, which we have mentioned in each of these financial sessions. Very important, very timely with April 15th around the corner. We'll look at the 5 best indicators of business growth. Some will apply to your world, some will not. And we'll also discuss the 5 barriers to small business growth. What could get in our way, including ourselves. And then we'll look at 8 key factors for sustainable business growth, because if we're going to do it, we want to do it right, and we want to put ourselves in a better position than when we started the growth process. And then finally, growth is great, costs money. Excuse me, I'm getting some background. We'll look at some funding opportunities, and we'll examine the pros and cons of each of the ways that we could fund business growth or expansion. So from Profit Mastery, here were 7 things that were talked about and practiced in depth, all outstanding ways to maximize the value of your business. Plan properly, monitor financial position, understand that price volume cost relationship, manage cash flow, manage growth, which we'll talk about today, borrow properly, which comes up today, and also plan for transition. We've heard from some accountants, and there's some consistent top tips that accountants have offered to small business owners, and we wanted to review those with you today. One, equally important to the others, is to keep your personal and your business finances separate, not to mingle the two, even if you're a sole proprietor, even if you're the only one working in your small business. You want to keep the business funds and activities separate from your personal funds and activities. And programs like QuickBooks and many others out there help you do that relatively easily. The second tip that we know accountants like to talk about is they want to remind us to keep track of all expenses along with receipts or any documentation, so that later if we need to prove something or go back and refresh our memories about a particular expense, we have the documentation to be able to do so. Balance our bank accounts every month. Mistakes are much easier to find, and balancing is much easier to figure out if we're doing it on a regular basis. Use an accounting or record-keeping method or program to help categorize and record those financial transactions. Again, QuickBooks is one of many examples. QuickBooks is very commonly used and easy to use as well. And finally, don't wait until the last minute to file taxes. Your accountant or bookkeeper certainly appreciates that, because they have more people to take care of than just your business. And also, you can provide more accurate, timely information and feel good about that, what it is that you are reporting. So we've looked at some suggestions from accountants. Now let's talk to why should we care as small business owners? Why should we, as the owner, care about numbers? There's lots of reasons. What we've talked about consistently throughout the sessions are the following. Caring about your numbers helps you better understand how hard you're working for the money you're making. Many of us would agree that being in small business is often a following of a passion or going on a journey that we feel led to do. That's wonderful, very motivating. It's also important to know how much we are putting in of ourselves for how much money is being made, and that we are indeed making money. Caring about the numbers helps us do that. We will also be more presentable to a lender if we care and present our numbers properly and regularly. We certainly make tax reporting easier and more accurate as well. And when we care about the numbers and we keep a pulse on them regularly, we are able to compare our business with similar businesses in the industry or competition, maybe in our market area. Always good to have a basis of comparison. And then also to show creditworthiness to a bank, a credit card company, or an investor. We always want to be able to present not only to ourselves, but also to others if the need be, how our business is doing, and to be able to speak to that. Keeping an eye on the numbers helps us develop that confidence. And then finally, someday, you may want to sell your business or invite a partner on. Having some idea of the profitability of your business helps you know where to start, or even whether or not to have that conversation. All right, I'd love to see through the chat box, how many of you have heard of the term key performance indicators, also known as the acronym KPI? Maybe by a yes or a no or a thumbs up if you'd like to use a reaction.
We're getting in a couple of yeses and at least one no so far.
Okay, all right, very good. What is it? Key performance indicators are quantifiable measurements that are used to track business progress in the most important areas. And you'll note that that phrase, in the most important areas, is italicized. And I did that because it varies. It varies by industry, and it varies by specific goals of your business, what it is that we would want to measure in order to be the most helpful or the most important. Some common key performance indicators are things like number of leads generated if we're in sales, number of leads actually converted to sales, so taking what's in a pipeline and turning it into business. Maybe we want to watch for website traffic volume and see what kind of engagement, social media interactions that we're having. Looking at things like employee turnover, measuring employee engagement and or morale can also be very helpful. Sales and or revenue growth certainly are key performance indicators, as well as inventory turnover. And a couple of these we'll revisit in our conversation today. But again, I stress that these are just a few examples of common KPIs or key performance indicators that may or may not apply to your world, but having key performance indicators, keeping track of those and looking at those measurements on a regular basis can have a dramatically positive result on you knowing how your business is doing and where it is that your business is headed. I'd love to hear from you. Let's unmute. Let's speak out loud if you would. Let's hear some voices. What sorts of things do you measure in your business, and what's important to keep track of in your business?
Inventory.
Inventory. Okay. Are you in the retail business?
No, property management.
Oh, certainly. Okay. What you have available, what's open. Okay. Anyone
Yes.
else?
The cost of my business, how much I'm putting into it.
Absolutely. That can get out of hand pretty quickly, can it? We're passionate about our small businesses. Anyone else? What are important measurements for you?
I would think that the amount per sale would, amount of sale per customer matters.
Absolutely. Very cost of goods. Yep. Knowing how much it costs to sell or produce what we do. Absolutely. Great discussion, and thanks for adding to the list. Again, what we choose to measure for our businesses depends upon our industry, depends upon our personal and professional individual business goals as well. These are some of the most common. And the real important message here is that having some KPIs, having some measurements that we look at on a regular basis is good business. It's a best practice. So let's look at some top indicators of business growth. After all, this session is called Business and Growth and Funding. So let's look at the top 5 indicators, particularly for small businesses, that indicate that our business may be growing or it may be poised for growth. It may be that we are alerted to continue, that growth may be a good idea. These are the most common indicators of growth. Some may apply to your business and some may not. The best business practices suggest that these are indicators of very good signs of growth, like I said, or that there is a trend to realistically consider whether or not you wish to grow. It is a choice. So the first of the 5, as we pull back the curtain, is inventory is running out. And the property manager spoke up a moment ago about her inventory. When her property management inventory is running out, she knows that demand is high. Inventory running out applies to property managers, retail businesses, manufacturers, others who need supplies in order to make their goods or services available. Remember that not all indicators are going to apply to all businesses, and some of these may apply to yours and some may not. But inventory running out is a good indicator that the business may be growing or poised for growth. What do we mean by that? Inventory turnover ratio is calculated by taking the cost of goods sold, which a gentleman mentioned earlier, the cost of what it takes for us to prepare and create a unit to sale, and divide that by what is our average inventory. When we do that division, we end up with a number, and that number tells us how often are we turning over or replenishing our inventory, restocking our inventory. It's important here that we realize that comparing our particular business to others in the nation is important, because, for instance, a grocery store turnover is going to be a lot higher of inventory turnover than, say, the property manager that's on the line, just because of the nature of what is sold and provided to customers. The key to remember here is if your inventory turnover is higher than you've been experiencing, and you're finding that you're having to replenish that frequently, your inventory frequently, it may be that you're experiencing increased demand, increase in sales, and or it could indicate that you're expanding your customer base. So watching that inventory turnover and realizing how frequently you're having to replenish your inventory is a good indicator that there may be some business growth going on, or it may be time to consider business growth. The second common indicator of business growth has to do with profits and or revenue and the direction that those are heading. Recall that in the other sessions, we've defined profit as the net earning after expenses and all operating costs have been covered. And also that we have reviewed both how to interpret and how to put together the 3 most common small business financial statements, which are the income statement, the cash flow statement, and the balance sheet. These are essential financial statements that we want to keep our eyes on. Again, these previous sessions are available on the BMCC SBDC YouTube, so you can watch those at any time. What this indicator encourages us to watch is to see what's happening to our revenue, money coming in from any source, and pay attention to the sales of our particular product or service. This will be one of the few times that we say, watch the trend of what is going on with revenues or sales despite our expenses. And the reason I say that is because the trend of revenues or sales increasing in and of itself may indicate growth despite what our expenses are doing. But again, our best practice advice is that we always understand our expenses and know what it takes to create the sale. If we are purely wanting to see what's the trend, pay attention to previous years as far back as you can go and see what's happening to your revenue, what's happening to your sales. The third common indicator for business growth is if you have to hire or you're considering maybe I should hire additional employees. And here are some outstanding questions that you can ask yourself. If you have had to ask yourself or you've had these questions come up, chances are you may be poised for growth. Do your employees have too many customers or too many calls to handle? Sometimes this is indicated by customer complaints that you don't usually get, but all of a sudden you're hearing from customers that say, I'm not getting my calls returned as quickly as possible, or I'm not getting service and the quality that I'm quite accustomed to. Is the team regularly working overtime? Be aware of employee burnout. For sure. Skilled workforce, as we know, is a prime area of need across the globe, really, but in particular in Eastern Oregon. We don't want to burn out the employees we have. We want to keep them and take care of them. And equally important is the business owner burnout. If the business owner, you feel like you're juggling multiple roles and you're finding it difficult to keep up, chances are there is something that needs to be addressed. And it may be that you're growing, and to consider adding on more help may be something to think about. Another outstanding question is, have you had to turn down good business opportunities simply because you didn't have the capacity to take them on? The first or second time this happens, you kind of feel good about your business and you think, wow, I'm so busy, I had to turn that one down. But when it becomes the routine and not the exception, then we need to think about, how much can I really turn down and remain a viable business? Do I need to bring on more help so that we can take on business? Very good questions. The fourth of 5 indicators of growth or good reason to consider possible expansion is if there's a buzz, if you will, around your business. Business growth is not always quantifiable that we can see in our income statements or balance sheet, but it's also qualifiable, such as buzz. And the way we will define buzz for today's purposes is the general excitement or interest that happens to be around your business or around your brand. Buzz, if you will, can be a very good indicator that your company's moving forward. It has received the attention or good accolades of the community. Very good signs. If you're being asked to open another location or expand your market area, that too could be a sign that you're poised for growth. If your e-commerce shop is getting more requests and you're noticing that those requests are to ship products to new places, new states, new cities, or maybe across the world, this also could be an indicator of growth. In the marketing series, which occurred 4 sessions at the beginning of the year, also available on YouTube, we talked about e-commerce and the power of being able to introduce and sell your product online. You may want to go back and take a look at that and see if that makes sense for your business. You getting a call from an investor or someone interested in giving you money or loaning you money, these are good signs. It shows that someone is interested in your business, and it shows that they think that they could help you and perhaps make something from doing so. We'll talk about investors as a funding mechanism here shortly, closer to the end of the session. Another sign of growth is if you are invited to collaborate on something with another business or a community organization. That's another indicator that people are liking what they see. Your reputation is good. You have the attention of your market. And if people are inviting you to do things with them, that is one of the highest of compliments. Again, you could be growing, you could be poised for growth. The fifth of five indicators of growth, and then I'll take a pause for questions, is the measurements and what we do with those measurements. Let's go through a very quick reminder about ratio analysis. In session 2, we spent a lot of time on these division problems, and we looked at the most common ones. We're going to do so again, particularly which ratios support the idea that we may be growing or we should be considering. Remember that in ratio analysis, it focuses on numbers from your accounting records. So any of the numbers we need to calculate any ratio, we're going to find those numbers on one of the 3 financial statements: balance sheet, income statement, or the cash flow statement. And basically, although the word ratio analysis can sound kind of intimidating, I think, basically what we're doing is we're taking 2 numbers and we are setting them into a division problem or a ratio that helps us track trends. It helps us see the direction that our business is going. The trends actually, or the direction, is more important than the numbers themselves, because the numbers tell us what has happened in the past, what has already occurred. The trends helps us see which direction our business is headed, where possibly are we going into the future. There's no guarantee of that, but it can give us a peek into where it looks like we're heading. In the session 2, again, available on YouTube, we went through a number of ratios, how to calculate and what those mean. The 3 I would like to highlight today have to do with our topic of growth and funding in particularly. And those ratios are the current ratio, the debt to equity ratio, and the net profit margin. And you'll see on this slide how to go about calculating each one of these. I'd like to look at each one again, define them, and consider how each of these may help you assess growth. The current ratio measures liquidity. How fast can our business pay off its short-term debt using its current assets or cash? Banks like to see this number higher, the better. So 1 to 2 is where the businesses ideally want to be. If it's higher, then that's even better. I'm going to close my door here real quick. For example, if a business like Lee's Restaurant that we met in previous sessions, if a restaurant or a business has a ratio of, say, 3.5 times, it means that that business has 3.5 more times in assets than it does liabilities. Banks, lenders, funders like that because it assures them that at least in the short term, you're pretty liquid and you can pay off debts if needed. The debt to equity ratio looks at how much debt is in the business. So debt compared to equity in the business. So another way said is a comparison of what's owed to a comparison of what's owned. And on this number, we want that to be as low as possible. So banks say lower the better. The third financial ratio that helps us think about growth is the net profit margin. And this one tells us how many cents of each dollar is generating profit So if we recall Lee's restaurant, she had an amazingly high net profit margin of 74%. So what that told us was that 3/4 of every dollar of revenue that comes in, she is able to turn that into profit. A funder would be very interested in learning more about how she's doing that, because the more profit we can turn from the sales we are making, the better. Okay, at this point, I'd like to invite any questions or comments. This is a lot of information. Again, remember, it is available on YouTube, and your small business development advisors talk about these sorts of things every day with all kinds of businesses, and they are eager to help you as well. Any questions or comments so far about key indicators to growth, ratios?
Okay, I'll throw one out there. Starting out, one of the things growing wise, like you end up getting a credit card for your business, right? But you're proprietor, it looks like that might be a little bit more difficult to achieve right off the bat without just to keep easy track of your cost. I've read that you can do, just a credit card for your business for that purpose. Looking into that as a sole proprietor, is it advisable to get a credit card under your own name without the business and then pay through your business account off that credit card just to keep those costs and expenses all nicely bundled for, your materials and such?
Okay.
If that's clear.
Absolutely. It's agreed and advised that we keep our business expenses separate, distinctly separate from our personal expenses. Sometimes when we are a new business, you are correct. It's hard to start by establishing credit. And some credit card companies are more or less likely to allow us to open a credit card in our business name. First, we want to start having credit in the business name as soon as the creditor will allow so. That helps us keep things and expenses distinct. If, as in my business, maybe similar to some of yours, I had to start using my personal name first before I was able to get a business named credit card. Yes, you can do that. What you want to do is make sure, though, that that is not the card that you use for your personal expenses, but only the card that you use for your business expenses. Very good point.
Susan, we have another question in the comments too. Will you provide examples of each ratio? I think that was something we covered in, let's see, was it the second session?
It was, and I appreciate that question. Ratios are very interesting. It's powerful knowledge to have. For the sake of time on this particular session, we have quite a bit yet to cover. I would suggest that you go visit the YouTube video for session 2. It went into a number of ratios and how to calculate those and what they mean. And I would also encourage you to visit with your small business development advisor about the most common ones as well. Great question, powerful information.
And that's perfect. They mentioned too that they would check it out on YouTube. So I'll send that link in the chat.
Oh, sounds great. Okay, thank you, Eric. Wonderful questions. Well, let me ask you a couple to continue this great level of engagement. Let's do a couple true or false and see what we're thinking out there. The first, true or false, accountants advise small business owners to balance their business accounts on a monthly basis. True or false? You can type in your chat, you can speak up, whatever you'd like.
We're seeing lots of trues, which means that they're remembering the things we saw earlier. Great.
Right on. It is very true. CPAs advise us to, we know it makes sense. Mistakes are much easier to find when they're discovered soon after they happen. And so balancing our accounts on a regular basis, monthly basis to the bank statement is an extremely good best practice. Okay, very good. We've talked about indicators that our business may be growing, indicators that may suggest that we might consider growing. Those are great indicators to be aware of. Equally important is to think about, well, if I grow my business, what is it I'm going to do with that excess cash and that excess growth? And followed by this conversation, we'll look at what are the barriers to small business growth? What gets in the way? Because what we'll find is that we often get in our own way. And identifying those potential barriers can help us be prepared to go to a funder. We'll know what the questions are ahead of time. When we say we're going to grow, that has to do with investing back in our business and considering what it is and how it is that we're going to grow. Note that we have a variety of things we can do as we grow our business. One is we can invest back in our business. And in this sense, it means directing the increased income to a place in the business that will benefit the organization for the long term. So it might be things like buying equipment or supplies, increasing or diversifying inventory, giving bonuses, taking care of your employees, hiring more of them. Maybe it's buying or building your own building so you're not paying someone else's mortgage by your lease payment. Maybe it's adding a new product line, so on and so forth. Those are examples of how we may invest in a business, which is one of the things we can do to grow. Another approach we can take for growth is to consider a boost in our marketing efforts. We know that marketing is not inexpensive. When we grow, when things are going well, and when these indicators suggest that we're growing, that's actually an outstanding time to consider boosting in marketing, doing more regularly, looking at your social media presence and touching more people than maybe you have in the past. Consider boosting marketing efforts is also a way to grow. And then the other two, if we're poised for growth, it could be a good time to eliminate ineffective products or services. Taking the time to evaluate products and services can be expensive. It can be time consuming. And making changes to what we do also comes at a cost. So if sales and revenue are on the rise, it could be a good time to take a pause and really look at what are we doing well? Where is the majority of our sales growth coming from? And then finally, as we grow, we may look at our strategy and ask ourselves, do we need to change our strategy? Any change takes money. Anything we do costs. So depending upon what the ultimate strategy we take is, there will be a cost. So as sales and revenue are on the increase, we may consider taking some of those dollars and looking at our strategy, sitting down with our Small Business Development Center advisor and looking at, should I do things differently? Should I add something, or should I change something to what I'm doing? Okay, so we have looked at the 5 indicators of growth. We've also looked at what sorts of things could we do as we grow. Let's be also familiar with the common barriers to growth. This is looking at how we can get in our own way of growth by learning about what sorts of things trip us up sometimes along the way. It's good to know what these things are. It's excellent to assess whether or not they're occurring to us in our small businesses, because when we go to a funder to finance growth, should we decide to do so, they're going to be looking for how we are diminishing the barriers or how we are preventing the barriers from getting in our way. We've spent time today talking about KPIs, key performance indicators, and the importance of those. Deciding what to measure and consistently monitoring those is extremely important to do. All these points about key performance indicators and measuring what's important are considered good starting points. I emphasize good starting points, but for many small businesses, it takes a while to truly see growth and what it actually looks like, and to feel confident that maybe it's time to grow, maybe it's time to make more investments. So what sorts of things can get in the way? The first is we can fail to identify growth opportunities. Again, we as business owners can get in our own way. I encourage you, do not underestimate your pipeline. Sometimes as business owners, we get so caught up in the day-to-day that we don't think about next month or next year or the next 3-year, 5-year period. Always, we want to be working on our pipeline, whatever that looks like in your business. Where's the next sale going to come from? Who and how is the next client that we serve going to come in? And how and where is the next customer going to be coming in our doors to purchase our product? Be very aware of which areas are doing well, and in particularly the best. I've worked with some small business owners that say, well, what do you mean? As long as I'm making money, then that means things are going well. Congratulations on making money, but that is not an indicator that things are going well. We want to know where and how and why things are going well. And finally, know how much it costs to increase your sales. Someone brought that up earlier. For every sale we make, there is a cost associated with that. There may be a point in our business where growth doesn't make sense because we can't finance that growth or keep up with that growth. Failure to identify growth opportunities is common. I've been guilty of it myself. Overlooking the competition is also a common barrier. We want to know the SWOT analysis. We want to know what are the strengths, the weaknesses, the opportunities, and what are the threats that our competitors may be dealing with or pose to us. Just like we want to know our own business's strengths, weaknesses, we want to know that of our competitions as well. Know your competition. The third common barrier is that sometimes we forget to put people first. What do we mean by that? Literally 40% of organizations report that they have been negatively impacted by a lack of skilled workforce. That is a national response. In Eastern Oregon, it's even higher. We have done a great deal of work around skilled workforce, and we have found that upwards of 3 out of 4 business owners will say, I have a hard time attracting really talented people. I have a hard time keeping my employees. Those are real factors for a small business. If we invest in professional development and training, and we're always on the lookout to surround ourselves with great people, we will be better apt to prevent not putting people first as being a barrier. Always, we want to be thinking about building a bench, such as building a bench of independent contractors to help learn our business and to contribute. An example there for you or others might be outsourcing certain functions, such as website design and maintenance or social media updates. It can be less expensive sometimes to outsource those functions, and it gives you, the business owner, the opportunity to have more time to focus on your business while having another person focus in on the engagement or the marketing effort. And then in time, as you grow, maybe you bring that person on, or maybe you bring that function back in-house when it makes sense. The fourth, and we'll go through 5 and I'll pause for questions. The fourth common barrier to growth is that we underestimate the risk that comes with growth. With growth comes risk. always. Even if we're doing well, that trend is not guaranteed to continue. With growth comes risk, and understanding that risk and being comfortable with it is very important. How do we be more comfortable with the risk that we take if we grow? Is to have a plan. Just like starting a business and the value of having a business plan, so is true as we grow. Have a plan for that growth, and also have a plan B, because maybe as you start to grow, you may want to make a change in direction, or maybe that growth doesn't quite go the way you hoped it would go. What's your plan B? Always get back to the basics of having a business plan for where it is you want to go and where it is you want to be. And then finally, just as importantly as knowing the strengths and weaknesses of our competition, we want to know the same of our own business as well. Strengths, weaknesses, opportunities, and threats. The fifth common barrier to growth, and the banks will look for how we are planning for cash flow issues. Let's look at some facts. 90% of small businesses say that they closed their doors because they couldn't keep up with expenses. That's a cash flow issue. Taking that statistics a little further, we know that 20% of businesses fail in their first year, 30% of businesses fail in their second year, and 50% of businesses fail even after 5 years, which is a long time. When we look at that, we're reminded that 9 out of 10 businesses that end up closing close because of a cash flow issue. In other words, expenses have exceeded the income, or at least the timing of the expenses has not come in alignment with our income, and we've had a hard time keeping up. A line of credit may help your business even out the dips in cash flow, or as the business owner said earlier, a credit card of some sort to even out the dips in cash flow. A line of credit's valuable because we only borrow what we need when we need it. We only pay interest on what we borrow. And a line of credit or credit card gives us the flexibility to pay down that short-term debt when the cash flow allows us to. So having a line of credit or credit card may be a way to help us plan for cash flow inconsistencies. We'll talk more about lines of credit shortly in the final segment. At this time, I'd like to open it up for any questions. And I'm going to check our time. I see that it's 10:07. I know we got started a little late. I'll check in with Eric. Are we good for another 10 minutes since we got started late, Eric? Or would you like me to begin wrapping up?
Yeah, I think for those that are still on the call, we can hang out for another, we'll kind of finish it up over the next 5 to 10 minutes, and
Okay.
that should be good.
All right, we'll do so. Any questions about the barriers to growth? Preventing those barriers. Okay, let's look then at how the small businesses sustain their growth. There's some key factors here. And again, if we're aware of what these are, and our business plan for growth touches on these key factors, our funders or potential funders will see that we are prepared for growth. We understand what it takes. Team trust. Without trusting our team, there's no way that we're going to be able to scale our business to increase volume and grow the business. Business growth, as you know, requires a focus on the next opportunity all the time. So we can't let the day-to-day functions of a business get in the way. We have to trust our team for many of those things. Trust is the foundation to all things, including sustainable small business growth. Deep market saturation has to do with saturating your current market as well as you can and as deeply as you can, more importantly than being available in open or multiple territories. So am I doing really well where I am? Is very important as we consider expanding to other markets. We've talked about clear performance, key performance indicators a lot today. And as we've talked, they allow us to keep a pulse on the metrics of the business. And then another key factor is cash generating mechanisms, diversifying the ways that you bring in cash. The bank is going to look at how many income streams or how many ways does our business have to bring money? Are we 100% dependent upon one, or are there a multiple number of ways we bring in business, products, services offered, variety of clients, those sorts of things. All growth is good. This is a true or false. All growth is good, so businesses should go for it. True or false? What do we think? Chat box or unmute? All growth is good, just go for it.
Seeing lots of falses.
Exactly. It is false. Growing a business requires a plan and a tolerance for risk. And growing is not always the best approach, even if there are indicators that we're growing or that we might consider growth. It's a serious undertaking. So if we decide to grow, that's going to take money, and we need to have some risk tolerance, and we certainly need to have a plan. We're going to need some money. So let's look at some ways that a small business can finance growth, and we will fly through and touch on the pros and cons of each one of these as well as we do so. Funding growth, funding a startup is also a topic that your small business development advisors work with folks all the time on. So I encourage you to have an individualized conversation with them about funding growth. Loans, money from investors, doing a loan from yourself to your business, getting into a partnership, or going for a grant. These are some common ways that we know or come up when we're talking about funding growth. Loans, I think we know what those are. Loans has to do with money that's borrowed, and there is an expectation that we pay that money back with interest. We can get loans from banks, credit unions, another person. As I mentioned, we can take a loan from ourselves, but the understanding is that loans are to be paid back. So when we take out a loan, we are creating a debt. We are making ourselves less liquid. So we want to be aware of that. And we are bringing on a monthly expense that we did not have before. So we get back into those financial statements and make sure that we can pay for that, and we're ready for that. Banks, credit unions, as I said, another person. The Small Business Association, or SBA, is an incredible organization, and all banks know about them. They will often underwrite a loan for a small business, in other words, guarantee a loan so that the bank is more likely to take the risk, especially if we are just starting out. SBA, Small Business Association. Another way to fund growth is to find an investor. This is a person or an entity that allocates capital with the expectation of a future financial return or the ability to gain some sort of advantage. So this is someone sharing their capital with us so we can use that capital to grow our business. This loan from self to business is a very common way that small businesses fund growth. This is when you, the business owner, allows your business to borrow funds from your personal cash assets with the expectation that your business is going to pay you back, usually with interest. This is a common way for small business owners to consider because It's less of a credit risk for an outside organization to consider. And you believe in your business more than anyone else will believe in your business. And another pro is that you would have the flexibility as to how much and at what pace you pay yourself back. It certainly assumes that one has personal cash assets that they're willing to make available to the business. Again, serious, costly, and we need to make sure we're comfortable with the risk. There are two more funding mechanisms to consider. First, a partnership. This is an arrangement where parties agree to cooperate in order to advance their mutual interest. The partner could be a silent partner, meaning that they're not involved in the day-to-day operations, or they could be a managing partner, meaning that they, as you, have some day-to-day responsibility and their voice is heard on a regular basis as to what's happening in the business. Either way, partnerships involve some sort of a commitment of money that is designed in purpose to help the business. So going into or pursuing a partnership could be a way that you could fund growth as well. Just be aware, the partner may wish to be silent, or the partner may wish to be a managing partner, and think before you engage on which or both you would be interested in talking about. Finally, there are grants out there. The reason that this potential funding mechanism is listed last in the list of 5 is because the reality is grants are uncommon for businesses that are set up for profit. Your business, my business, are they out there? Yes, particularly during extreme times like now with the current pandemic, but generally grants are intended for nonprofit or public organizations. And it takes time and energy to seek the grants and apply for the grants. They are uncommon for businesses that are set up for profit purposes. Now, having said that, do know that right now, during extreme conditions, grants can be offered, and they are, at the federal, state, and local level. However, do know that these grants must be paid back if they're not used in the prescribed way. And taking a grant as a for-profit organization is a responsibility to prove how you use the money. It's not free money. There are sometimes factors that may qualify a business for a grant, like a minority-owned business maybe, or a certain sort of industry. However, we remind you that nothing is free and that a business should not at all depend upon grants for funding business growth. Okay, due to sake of time, I won't open it up again, but I am very interested in what you all would like to continue learning about. Let's end with a true or false. Team trust is important, but it has little to do with finances, let alone growth. True or false? All right, false. Team trust is the foundation upon which everything else is built, including business growth. It absolutely cannot happen effectively or sustainably if we do not have trust in our organization. I will pose this question and ask you to type in the chat box for sake of time. 2 thoughts. 1, what was the most helpful or interesting thing to you from what we talked about today? And 2, we are very interested in what you would like to learn more about in future sessions. Please share your thoughts on either or both of those questions in the chat box. We've been through 4 financial essentials topics. This is the 4th and final, but do know that it's not the last educational opportunity that the SBDC will offer. Be looking for emails, watch the Facebook page, and get on any distribution list by reaching out to your SBDC advisor or Director Eric, and you won't miss any opportunity. Here again are who those folks are in our region, as well as how to contact them. I'd like to thank you for your time and attention today. Thank you for bearing with us during the startup hiccups. I'm glad you were here, and we wish you to be safe and healthy, and best of luck in considering business growth. Have a great day.